Hey, Jordy.
Hey, Ian, welcome, welcome. Um, I don't know if you want to do a little shout out about the fundraiser for the Lawyers Feed the Hungry and the plays, the performances that are coming up.
Oh, that's nice of you. Thanks. Quick shout out. We're doing Billiards with the Bar. That's on tonight. It's on our website and our all the details. And then we're also sponsoring a play at down in Pottery Road Theater, and proceeds are going to Lawyers Feed the Hungry. It's a big weekend for fundraising. So thanks so much.
Yeah, and you can always post that in the chat with any details if anybody wants to join. I'm going tonight, Ian. So
Awesome. You're a good friend.
yeah, excellent. I'm excited. So, welcome everybody. This is one of my favorite discussions, and it's about what seems like a very simple instruction that we get regularly from clients, and they don't understand the implications of this kind of instruction. And we're going to go through bequests and devises and deal with all of the different things that occur when you're thinking about giving away a specific asset. But before we get into the very fundamental question, Ian, anything you want to start off with?
No, that's great. I'm encouraged by this talk because it always comes back to that heavy importance of it's much better to do a will with a lawyer.
Yeah, for sure. So this is a particular area of concern for me. I hear from lawyers very, very often about instructions they get from a client who wants to give certain assets to certain beneficiaries. And the first thing we must always ask when a client tells us to do that is there a really good reason to give this asset away separately as a bequest with no kind of condition or other um, uh, uh, attached provision? Because we know when you give away an asset, that asset is never going to be worth exactly what it is on the day they give you the instruction to give it away. So what the client is doing is they're trying to be a fortune teller, um, and trying to predict. So often they try to predict, well, this asset is worth about the same as that asset, and so I'm going to give this asset to this person and that asset to that person. And um, when I'm confronted with that instruction, I analyze, and I really encourage all of us to analyze, is it necessary to give this asset away specifically? Why not have it fall into the estate, into the residue of the estate, and deal with like any other asset? That's the first thing. And often the answer is because this is a very unique asset. Okay. It's not a bank account. It's not, it has a unique characteristic. And then the question becomes, well, do you really want to give that asset to this beneficiary? Or are you just, is it just that you think this beneficiary will want this asset as part of their share? And that is a completely different analysis. Um, because you're going to approach that completely different than giving away a specific asset. Um, and it's very dangerous to give away a specific asset unless it's absolutely necessary. That's my little first pitch whenever you get those instructions. Ian, anything to add before we get to the 14 items to consider every time we make a specific bequest or devise?
No, I'm not going to slow you down.
Okay. Well, these are 14, and I believe they're not all of them by
No,
any
no,
stretch.
I have one brother, that's it.
Yeah, could everybody please mute so we're not interrupted? That would be great. Thank you. Um, Here are 14 things to worry about when the instructions are to give a specific asset, and we're going to go through them. And again, the slides will be available for eState users, of course, so you can refer to them. So the first thing, obviously, when we're giving away a specific asset, is we have to identify and define that asset specifically. And the key here is, would anybody reading this will be able to identify this asset? That's what we need to get to the point. And so
I will. You online? No. Oh, okay.
Okay, sorry. Somebody keeps unmuting and I'm gonna like basically make you leave. So that's because it's distracting to everybody. Okay, so consider using an asset definition anytime you're giving away a specific asset. If it's jewelry, define the jewelry. If it's a ring, make sure it's described properly, that anybody could reasonably understand what it is. And the other thing to consider, and we'll talk about real estate, Ian, and maybe you can address that in a moment, but when we're describing a group of assets, personal effects, for example, and personal effects are being distributed in a certain way, that's fine. But what happens if somebody argues that this asset is not a personal effect? It should be part of the residue, or vice versa. Building in something for a dispute mechanism or leaving it to the discretion of the trustee and executor might solve that potential problem, because I'm involved right now in a case where that's an issue as to whether a certain asset is governed by a bequest or part of the residue. So it's also the case when we're dealing with real estate, and we get this question all the time, Ian, right? Do we need to do a title search for real estate? What are your thoughts there?
Sorry, my thoughts are exactly what yours are, and that is, I encourage my clients to do it, and if they won't let me do it and they don't want me to go to that expense, I put it in my reporting letter, because at the end of the day, I'm not going to wear their recollection of how it's held.
Right. And it's so easy to do now, right? I mean, it used to be a huge pain. Now it's very easy to do. And so confirming the ownership is really important. Anytime you're giving away assets, confirming the ownership, and we'll talk about that in a moment, and confirming the legal description, very important as well. So I certainly would recommend that if you're giving a specific piece of property away, that you do a title search for that. So I've given some examples of kind of how we would deal with that, and in a draft. You can also think about other properties, especially when you're dealing with real estate. Properties are sold, and then another. Okay, sorry about this. I'm gonna have to remove you. Sorry. So other property that's purchased in substitution for that property. Often they say, oh, I want to deal with my home this way, but if I sell that home in my lifetime and buy another home, I want that to be applied in the same way. Well, then you can build that in as well. And there's always the risk where there's co-ownership, where you don't own the entire, or your client doesn't own the whole property. So dealing with that is also an issue. A part of an asset is rarely, it's certainly limited as to what you can do with it. So if you're giving away 25% of a property, you're going to be in that same situation where you're now a co-owner, or the beneficiary is now a co-owner. Any thoughts on that, Ian, on real property?
No, I don't think it's much to add. We got a long list.
Yeah. All right. So this is especially the case with real estate and real property. And if everybody could just 1 second. Could everybody just make sure you're muted and your video is not on? That would be helpful, because our bandwidth we can have some issues. Thank you. Associated assets, locker units, parking units, things like that. That's an issue. Contents and vehicles, boats and things. Are those supposed to be included with the gift or not? So those are what I call associated assets. And part of our checklist is to make sure that we're covering those if those are intended. Because if we don't refer to them, then they're not necessarily intended or going to pass as part of that gift. Ian, you just stop me with any comments as we go.
No
I'll
problem.
have more to say certainly about the income tax issues. And then mostly for real estate, although there's certain personality that has associated debts, mortgages, encumbrances, and generally debts go with the bequest, right? So if there's a mortgage and you give away the house, our law, Section 32 of the Succession Law Reform Act, deals with the debts go with the gift, unless there's a provision to the contrary. So that's something to consider when you talk to your client. Do we want the gift, if we're giving a property, do we want them to assume the mortgage, or do we want to discharge the mortgage from the estate at the cost of the estate? So that's what I'm talking about there with associated debts. Here's an example just of the kind of language that you might include if the instructions are, yes, I want you to pay off the debt if there's a mortgage. Let's talk about this one, Ian. I know you've got thoughts on ownership, right? Ownership is so important. I've mentioned this many, many times in our webinars. Having a client understand that it's only an asset that they own personally that's going to go through the will. So what about situations where it turns out that the corporation that they solely own owns the asset that they're trying to give away, and they don't actually own the asset themselves? And Ian, do you want to just address that and the issues there?
Full disclosure, I'm just running into a quiet room.
No problem.
Good.
I will take that. No problem. So we typically include a clause that says, listen, if I'm making a gift of a particular asset and it turns out I'm not the owner of that asset, a corporation that I control is the owner, I want the directors of that corporation to deal with that gift and fulfill that gift. That's important to do, although there is case law from the Court of Appeal that now, at least in one case, said, well, we're going to read that as a gift by the person, and we're going to direct the corporation to do what they've said to do in the will. So that, but it's a good clause to include, especially when assets can, they could be owning it personally right now, transfer it into a corporation in 3 years, and then die. We've got that issue. Right. I'm going to assume you are there.
I'm
there
back.
You go.
Sorry. I'm good.
No
Sorry.
Yeah. So
I don't have much to add to that.
Yeah, that's the Earl and Willem case way back when, and then a newer case that skips my mind right now from the Court of Appeal, starts with a T, where the court said they read this in and said basically read this clause in to the will. So
yeah, and the Earl and Wilhelm case, of course, is a important one where the court criticized the lawyer involved and made sure that we all understood that we're not scribes and that we are obligated to drill down on the question of ownership and not just simply take it as a descriptive. And that comes back to your point about getting sub searches on title and things like that.
Yeah, and obviously it's important to if you don't give tax advice, to explain to the or get tax advice on how this would actually work in practice. Giving away an asset that's owned by a corporation, how would it flow and things like that. So that's a red flag for us, non-tax people, to make sure that the client is, at least, or recommend that they get some tax advice on that. Here's the classic problem with giving away a specific asset. It might not exist and be owned by the testator on the date of death. So what happens if that's the case? That's the rule about redemption. We've spoken about that before. The general rule is if you give away the piano and in your will, and the piano doesn't exist or was sold prior to death, the beneficiary gets nothing. So if a client is coming to you with a great plan, they're going to give one property to one kid and another property to the other kid, and that's perfect because they're going to be, and it's, for whatever reason, it's going to be exactly the same, and they're all okay with that, and they've got this, and I don't care if there's a difference and all of that, and they sell one of the properties. Doesn't work. Disaster ensues, right?
Yeah, and a big part of that is, and you do get clients who are going to dig their heels in on this kind of planning, and it's great. I mean, that ultimately you can only give advice, and they'll only listen as much as they want to listen. But that's where I always remind them, okay, that's fine, but I need you to come back in 5 years and let's have a refresh and let's look at your will, so that, you know, if there has been something significant changed, we're going to avoid these kind of catastrophes.
Yeah. And you get this occasionally where, you know, the person's incapable, the attorney for property has to figure out which property do I sell to, you know, there's that issue as well. I mean, but we have rules about that as well. But so then there's always the question of, and especially real estate, what about the expenses pending the transfer to the beneficiary? Who's going to pay for those? So that's just a quick thing to think about when you've got one of these gifts. Cost of delivery, and this is kind of part of the same thing. Who's going to pay? And this is the case for personal effects or property and things like that. Who's going to pay to transfer that? Who's going to pay to deliver those items? You know, I would like to see, you know, in the wills I draft, I try to include something about that, you know, because that can be a fight.
Yeah, it's funny, you know, how little things become the fight, right? And you know, we've both been in mediations at the end where we're trying to deliver. Maybe it's a valuable item, a painting of some sort that worth some significant value, and the process and cost of delivery across to Vancouver is a fight over it. It sounds silly, but it's an easy thing to get ahead of with the drafting.
Yeah, it is amazing how the littlest things cause the biggest concerns for everybody. Like so now I just want to talk about conditions. This is really important on income tax. Okay. Here's the, you know, we talk about redemption, the idea that the asset might not exist. That's a big problem with specific gifts. This is another huge issue with specific gifts, because not only are you giving the asset and pulling it out of the residue and giving it to somebody specifically, but assets have different tax ramifications. If I think I've got this great idea, I've got an RSP, you know, and it's worth 100 grand, and I'm giving 100 grand to this other person, I'm going to give the RSP to that person, that other beneficiary. It has huge tax implications for both people. And same for real estate, same for, you know, stocks, same for, there's got to be a really, really good reason. I've used two reallys now. Really, really good reason to give away a specific asset. And if we're going to do that, then I would like to address the tax implications of that. And you might say, well, it's a principal residence, there's not going to be any tax. No problem. What happens if it's not a principal residence? It might not be a principal residence when they die. We're fortune tellers. We're acting like fortune tellers, right? So one thing you could do is you could make the gift conditional on the payment of tax. So you say you get this gift provided that, you know, the beneficiary pays the income tax on that, or the probate tax, or the whatever it might be, the expenses, the costs, the land transfer tax, the whatever expenses the estate might otherwise incur, or the residuary beneficiaries might otherwise incur.
And again, you know, these things can be a sharp poke in the eye to someone. You know, they say, okay, fine, that asset went to my brother. I'm not happy about it. It was an asset that I wouldn't have minded as myself. But then I get a poke in the eye that I'm going to carry the sort of the residual cost of the transaction. And it can be a real point of friction, and it's an unnecessary point, because I think when you ask most clients if they want to do that, they're almost always going to give you the right answer. And that is that the tax should be paid by the recipient.
Right. And, you know, it's hard to challenge if the client said, listen, I want this property to go that, you know, person A. Okay, yeah, listen, that's what it is. They're allowed to do that. If on the other hand, there's nothing to discuss, there's nothing in the file about who is to bear the tax, that's when we got real problems. So I've given a few examples of the conditions where tax is going to be, you know, going to be dealt with by the beneficiary. Here's the most common solution to when I have clients tell me they want a certain asset to go to this person. This is often what they really mean. They mean, I would like this beneficiary. I think they would want this asset and I want them to have it. And I want them to have it as part of their share of the estate. You know, that's really, in most cases, that's really, when you drill down, that's what they want. I don't want to treat my kids unequally. I think my son should get the house. That's no problem. We can do both. How do we do both? Well, this is called deduct from beneficiary share, or a kind of like a hodgepodge arrangement. But it's basically this idea that you say, I'm treating my beneficiaries this way, A and B, they're splitting the residue. But as part of in this case, Jay's share of the residue, he can take the home as long as it works out, you know, properly, and he pays all the expenses and all of those things. And so that concept, when most clients are, when you put that to most clients, that's exactly what they're talking about. The other thing that, sorry, Ian, jump in there.
No, that's great. I apologize to interrupt. I got to jump on stage now. I'm at FIDRIO and I'm speaking in 5 minutes. So I'm going to let you finish off today's podcast. Thank you so
Thanks,
much.
Ian. See you tonight.
Yeah, thanks again.
So this is what most clients really want. You know, the other thing is they assume their kid wants what they want them to have. You know, oh, I know my kid's going to want the home or the cottage or the this or the that. And then when the time comes, what happens if the kid doesn't want it? Like they live in a different jurisdiction. Now they're stuck with real estate that they didn't want in the first place. Well, this adds the flexibility to allow them to take that asset if they want it. You can think of it as an option to purchase it from the estate. It works the same way. And they get the option to take that if at that time that's what they want to do. You know, again, this is there a really, really, really good reason to give a specific asset away? Maybe really what they're talking about is this idea of the right to receive it as part of their share. So keep that in mind as really the outlet pass in most cases. Giving away a specific asset to a minor, it's a problem, right? Minors, and there's this misconception that minors can't own property. Minors can absolutely own property. They just can't deal with property. So a minor can own property, but they can't sell it, and they can't transfer it, and they can't mortgage it, and they can't do anything with it. Somebody has to do that for them, a guardian of property. And so that's the issue with minor beneficiaries. And so obviously, if a client says, I want to leave my, and I hear this all the time too, my client, oh yeah, I want to leave my house to my 12-year-old kid. I want them to get it when I die. It's really a great house and all of that. Well, that ain't going to work. So, you know, come back when they're 18 and we'll talk again. There are obviously other answers to that, but that's a red flag. For real estate, there can be an issue with environmental matters. And so if you've ever appointed certain of trust companies, you would see that they insist on an environmental protection clause. So it's obviously in estate, it's an option for you to put in there. But it's something to consider as well when real estate is involved in a gift. And we talk about sort of the conveyancing costs and the legal fees and all of those, land transfer tax, if there is any. I mean, again, that might be applicable or not, depending on if you use an option to purchase versus another mechanism. So those are issues for dealing with real property as well. We have a couple. One thing I'm going to do pause before I've got some other things to say about specific gifts, but just wanted to let everybody know what's coming up for the next 2 weeks. We've got two special guests who are coming to speak. So next week is Ray Leclerc from Law Pro. So Law Pro is coming, and he'll be speaking about solicitor's negligence, trends in that for estates and things like that. He does that every year for us. So it's we welcome Ray back again. The next week, December the 5th, is a very special one. Nicole Richmond is going to be speaking about Indigenous issues, especially in respect of estates. It's going to qualify for 30 minutes of EDI credits. So we do hope that everybody considers joining us on December the 5th for that very important discussion. You get EDI credits if that's of interest and a need for you as well. I just want to show, before I go on to one other point, obviously if you use eState and you're giving away assets, all of these issues are automatically built in, right? So if you want to do a condition of payment of income tax or those kinds of things, it'll automatically build that in. You just use your checklist and the gift, and it'll draft it and all of those things. So I just want to point those out for anybody who's an eState user. Again, my final thoughts on this. Ask your client and ask yourself when you're given these instructions. And I've added a bunch. I've added 3 reallys. I had 1 to start with, then it was 2, now it's 3. Is there a really, really, really good reason to give this specific asset away separately? Or can we have it fall into the residue? Is it just money? You know, why are we trying to figure out what that's going to be worth? Why are we playing musical chairs? If a client says to me, well, I want this bank account or this investment account to go to this person, that could be worth 0, or that could be the entire estate. Same with corporations, same with bank accounts. It's musical chairs. When the music stops, they get whatever's in there. That seems to me to be a crazy plan. So, you know, ask the client, what's the difference between having that go into the estate and part of the residue and dealing with it that way versus, you know, this idea of a separate asset. And if we are going to do a specific asset bequest or devise, definitely make sure, if we can, to cover all of these issues and document any unusual instructions or that we've talked about these matters, because these specific asset gifts are the most fraught, I think, of any kinds of gifts. Those in trusts are fraught with difficulties and dangers because circumstances are going to change. And so, you know, obviously a review of wills when you have specific bequests, really crucial for your clients and for you, to be absolutely honest. So we really caution you. And it's something that we see a lot of younger lawyers reach out about, less experienced lawyers who say, well, my client wants to do this, my client wants to do that. And I'm like, oh boy, those aren't good instructions. Those are ones that we as lawyers, this is where we add value, where we can give advice to the clients as to why we don't do this. Did they really realize there were 14 things that could go wrong or that we have to consider? And in most cases, they haven't. So I want to thank everyone who was here, and those who watch the recording. Just a heads up about this, and hope to see you next week with Ray and with Nicole the week after. And hope you enjoyed it. If you did, please feel free to share the information, the sign up with, you know, and the experience that you have here with your colleagues. And we welcome as many people who want to join us as are available. So thanks again, everyone. Have a great rest of the week. We'll see you again.